It's getting harder to stay overweight China. Why not? Why not change, or at least given the extreme bearish out there?
Well, Yvonne, I mean, to be 100% honest with you, I think the weak market performance has been frustrating for us and for a lot of fundamentally focused investors. Not only because the market is correcting, it's been weak, but the weak performance has come against a backdrop where fundamental earnings are improving. Now, if you look at first quarter earnings as a whole, we look at more than 6,000 listed Chinese companies in the equity universe. The aggregate profit number was up 5% year on year. But if you zoom into the MSCI China constituents, you're talking about 19% up in terms of year-on-year profits in the first quarter, which is pretty respectable given the high base that we had in 2022. Now, looking ahead, based on our top-down modeling, we still think that second quarter earnings momentum will be very good. So we're forecasting more than 20% EPS growth in the second quarter. Now, obviously, we have to wait for another 2 months to see that earnings to come through. But I would say the recent sort of weak performance has been mainly driven by valuation derating. And if you look at MSCI China, right now we're trading on 9.4 times forward earnings, which is just 16% above where we were at the trough in late 2022.
Okay, so when can we actually find a floor? What would actually provide a floor now?
I think a lot of investors are looking for some catalysts to hopefully that would change market sentiment and change perception a little bit. I would say maybe 4 big categories of catalysts that we'll be very focusing on. Number one, obviously, macro data points. So April data points were very weak, and May is a little bit mixed, as you said. But seems like momentum is improving or stabilizing somewhat. Hopefully, we'll get more supportive data points from a macro perspective in the next 2 months. Second is fundamental earnings. As I said, second quarter reporting season will be important. But again, we have to wait for another 2 months for that to manifest. Number 3, obviously, policy easing or policy stimulus. And from GS perspective, we think a triple R cut is already sort of baked into our assumption. And I think it will be also likely to see more policy easings focusing on rate cuts, fiscal policy easing, as well as property market easing. Last but not least, obviously, geopolitics.
Yeah, if there's some sort of thaw, we'll see if we get that. You're upgrading also media, entertainment, insurance sectors to overweight, banks to market weight as well. What's the thinking behind that?
For insurance, I think the story is pretty simple in a sense that fundamentally, if you look at the whole sector, first quarter was very good in terms of premium growth and cost efficiency and things like that. On top of that, from a more macro perspective, SOE reform story has been, we've been highlighting that for quite some time. And we think insurance sector gives you very good thematic exposures to that story, given the representation of the sector in terms of POE versus SOE. So it's more like a combination of improving fundamentals, but also very appealing thematic exposure.
Yeah, you're also cutting semiconductors sectors. I wonder, just given what we've been seeing with AI and this global sort of rally and frenzy we've seen, why cut semiconductors? Has it gone too far, you think, this
Yeah, I think maybe just let me clarify a little bit. So if you look at China semi from an MSCI index construction standpoint, a lot of the big semiconductor companies are not in the benchmark, right, because of U.S. restrictions. So you're left with a lot of like renewable companies. I mean, longer term, they look fantastic in terms of growth potential, but in the short term, given the weakness in the manufacturing sector, seems like we can find areas where risk reward looks better.